Hello, everybody. Welcome to my Intermediate Accounting 17th edition video solution walkthrough. This is for exercise 1615. This is textbook authors are Don Kiso, Jerry Wang Yen, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 through 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of myself, Bennett Tchaikovsky, and not the authors of the textbook or of Wiley. Okay, so let's go through right over here and let's take a look. All right, so when we're looking at weighted average shares, let's just kind of take a brief look. So when we're looking at financial statements of companies, one of the important things for us to go through and remember is that as we're looking at the bottom of the income statement, you're going to see two numbers, which are essentially the weighted average shares on a basic level and then on a diluted level. What exactly does that mean? Basic earnings per share are those shares that have actually been issued. Diluted shares are what if we had convertible bonds, what if we had stock options, what if we had other certain securities that could result in the issuance of more shares of common stock. So it could be warrants, but the key is when you're looking at basic, it's the actual shares outstanding. Diluted are those potential shares. Another thing to just kind of keep yourself in the back of your mind is that if you have a net loss, you only do basic. Because diluted would cause the amount, it would be anti-dilutive, meaning that if you kind of look over here, the basic is higher than the diluted. If this was a net loss because you're dividing it by a greater denominator, and if you would not, if it's at a net loss, you never use diluted earnings per share. It's just going to use the basic amount. The other part of this over here too, and this is kind of why this is a good problem for us to use. We have warrants of stock. Generally, what's going to happen is, or excuse me, if we have stock dividends or if we have stock splits, we're generally going to retroactively adjust them. So let's look at this first one. Compute the weighted average number of common shares used in computing earnings per share for 2019 on the 2020 comparative income statement. So the number of common shares issued and outstanding on 1/1/19 is 2 million. Now, there's a 10% stock dividend that's being issued on September 30th. Now, what my thing in the back of my mind, what I would want to do is I'd want to say, oh, this was outstanding for 12/12 or the full year. This was outstanding for 3/12 or from October 1st through December 31st. But when it comes to a stock dividend or a stock split, we just ignore that. We just assume that it was done for the entire year. So the answer to A is going to be 2.2 million shares. So at 12/31/19, that's what it's going to be. The next one is compute the weighted average number of common shares used in computing earnings per common share for 2020 on the 2020 comparative income statement. So for 2020, my ending balance as of 2019 becomes the beginning balance for 2020. This was outstanding for the full 12 months. One of the things that might help you is that if you kind of look back at the weighted average construction expenditures outstanding, and I think that may have been from chapter 10, when you're kind of doing the interest capitalization, that part can actually kind of go through and help you. So right over here, I issued shares for cash on 3/31/20. I issued 2 million shares on 3/31/20. However, though, were these outstanding for the full year, right? When I'm coming down at 12/31/20, that's what I'm trying to figure out. The answer is no. These were not outstanding for the full year. These were outstanding for 9/12 of the year. So my total weighted average shares outstanding is going to be 2.2 million plus 1.5 million. And that's how we're going to go through and figure this out. So my weighted average common shares outstanding for 2020, the 2020 comparative income statement, is going to be 3.7 million. Now, compute the weighted average number of common shares to be used in computing for common share for 2020 on the 2021 comparative income statement. Now, what's different here is that for 2020, so this is going to be for letter B. Now, once I go through and compute this for the following year, right, what happens? Well, I did a 2-for-1 split. So what I'm going to go through and do is I'm going to do a retroactive adjustment of these amounts. I took away 1 share, I gave the investor back 2. So for my 2-for-1 split on that particular statement, this is going to be 7.4 million. Okay. So right over here, so the weighted average number of shares to be used for 2020 on the 2021 comparative income statement. Why am I doubling it here for 2020? Because once I do the split, I'm going to have to go through and make sure that the numbers of shares outstanding are comparable period over period. If I use 3.7 million instead of 7.4 million on the 2020, it would materially distort my financial statements. Remember too that the earnings per share amount is a very important item. Why is it so important? Because it gives the investors a sense about valuation. If I look here at Tesla stock price, so my Tesla stock price is right now at 905. If you look at the price to earnings ratio, what exactly is this? This means that if I take the stock price, divided it by my earnings per common share, it's going to take 185 years for Tesla to earn back its stock price. So the earnings per share is one of the more important things we have on our financial statements, so that an analyst can kind of sit there and compare, how potentially over or undervalued is the stock. So over here, when we're looking at letter D, so for letter D, there was no other things that were happening. So on 1/1/21, I had 4.2 million shares outstanding, right? So that's what I had during the full year. Now, I did a 2-for-1 split on March 31st, 2021. So when I multiply this through by 2 for the 2-for-1 split, I'm going to get 8.4 million. So this is how I'm going to go through and show my earnings per share. So again, let's just kind of recap this real quick. If we have a stock dividend, we're just going to go retroactively adjust it. We don't really care about, even though this happened partway through the year, we retroactively adjust it from the very, very beginning. On the second part, when we actually have over here, the common shares issued and outstanding, basically, if we have a share issuance, so for cash, we have to kind of say, well, this was on March 31st, 2020. Therefore, this is only going to be during the year 2020. This is only outstanding for 9/12, or for 9 months. Therefore, it's going to be weighted differently than those shares that were outstanding at the beginning of the year. Now, in terms of answering these other questions, right, because it's like, well, 2020 on the 2020 comparative income statement, 2020 for the 2021 comparative income statement, this is where it gets a little bit different. And the reason is because now we've done a forward stock split. When we've done a forward stock split, we have to retroactively adjust all of our earnings per share, or all of our weighted average number of shares outstanding, so that the earnings per share can be comparable period over period. So hopefully this has been helpful. we'll be doing more of these videos. So it'll be really exciting. In any event, I want to thank Wiley for allowing me to come in and to make these videos. Please don't forget to like and subscribe. If you would like to see other solutions, please feel free to ask for them in the comments. I look forward to seeing you on the next video. Have a great day.